Got this question from Colin on Twitter, or I mean, maybe you would want to call it X now. But he says, I would like to hear one of the Flatland Prairie Boys review microcap VCI or Vitreous Glass. Pays a juicy variable dividend, seems to be trading at a higher than historic PE ratio. Is it warranted? Crushed glass, who wouldn't like that? So I'll get into it here. We have featured Vitreous in several of our comprehensive annual cash rich reports as a monitor report for clients. So, we were just monitoring. So clients should be somewhat familiar with the company. And I know that Ryan has interviewed management several times in the past, going back several years as well. So Vitreous Glass, VCI on the TSX Venture, currently trading at a price of about $5.22, a market cap of about $32 million. And the company operates a waste glass processing plant in Airdrie, Alberta. The plant gathers post-consumer waste glass, crushes it, removes contaminants, and sells the final product to manufacturers of fiberglass building insulation for use as a raw material in their production facilities in Alberta. So the stock price has performed quite well since pre-pandemic, up just under 40%. And really the question is, what has been driving the stock price? Well, strong housing starts in Western Canada and the Northwest United States that spiked in 2021 has helped the company post good growth in its financials. And I'll show you that here. So here's a chart of housing starts. This is just in Canada. Given the company sells its final product to just 3 manufacturers of fiberglass building insulation, the company has very high customer concentration. So this is a risk. And as I just mentioned, sales are heavily dependent on housing starts in Western Canada and the Northwest United States. Now, despite the current lack of housing supply in Canada and the US, given the increase in interest rates, we have seen housing starts remain relatively flat in early 2024 compared to calendar 2023. And of course, if we look back to 2021, during the year, Vitreous announced that it experienced unexpected additional demand by 2 of its main customers. Again, it only has 3 customers, driven by an increase in housing starts in Canada and the US. And as indicated by management, they stated that the levels of supply of raw glass and the levels of demand by Vitreous's customers will continue to fluctuate beyond the control of the company, and these fluctuations are not susceptible to prediction or forecast by the company's management. So keep that in mind as we're going forward here. Now, looking at the financials, the last quarter was Q1 of 2024. Revenue was down 20% to $2.34 million. Earnings per share was down 18% to 9 cents per share. And cash flow from operations was a gain of $184,000, down from $781,000 for the same period last year. And looking at the valuations, trailing 12-month PE is about 13.7 times. And on a price to cash flow basis, the stock trades at about 12.3 times. And of course, it has a nice dividend. The trailing dividend payout ratio from earnings is approximately 95% right now. So historically, Vitreous has traded with a median trailing PE multiple or price to earnings multiple of about 12 times. So considering, like I said, I calculated it at about 13.7. It is currently above its historical valuation. And in the conclusion, I'll get into that a little bit more. Looking at the balance sheet, it remains very healthy with $1.68 million in net cash, which equates to about 27 cents net cash per share. And we do not see any real uses for the cash other than potentially supporting the dividend. As you could see from the company's long-term revenues, there really hasn't been much growth in the business at all. So to conclude, overall, I think that Vitreous is an intriguing microcap. The company has an attractive dividend yield of 6.8% and a trailing payout ratio of 95%. The balance sheet is healthy with net cash per share of 27 cents. Revenue growth has been relatively stagnant long term with a compound annual growth rate of just 2.5% from 2014 to 2023, and the company really has no long-term expansion plans. The company's current PE multiple of 13.7 times is above its historical median PE of about 12 times. And I think for a company like this, I would really try to catch the stock on a dip rather than a potential peak, given the unpredictable nature of demand for its recycled glass. And of course, the lack of growth expected from the business. So, Colin asked, do I think that the premium valuation is justified? I don't really think that the premium is warranted. That's just in my opinion. Now, of course, risks that I would like to highlight for Vitreous is that it is extremely illiquid. Only a few shares basically trade per day. Demand for its recycled glass can be quite volatile, and it has very high customer concentration with just 3 customers, like I said before. Now, investors with high risk tolerance looking for a green or recycling stock with an attractive yield could consider Vitreous Glass, but we continue to monitor given the risks and just overall lack of growth. But it's an intriguing name, definitely, and it's obviously been, we've been monitoring it for years and years. But it would be awesome to see the business really be able to grow further than what they have been able to.
Yeah, it'd be nice to see some type of an expansion plan there. And
yeah,
dividend payout ratio of 95% would make me nervous in terms of just the sustainability of the current dividend, given that they only have so much ability to predict what their earnings are going to be going forward.
Yeah, exactly. And that's the thing. It is variable. We could see, that it come down here going into the future. I don't know.
Now, on the flip side, one would potentially think that housing starts should be stable to higher in the future, given that we have such lack of supply. We need to build more housing, but
yeah, it's tough to say.
Yeah,
but I do agree with that.
It's just
to remain.
Sorry, the lack of growth long term is, 8.2 million in revenues in 2014 and 9.6 trailing right now, 2.7 million in operating income in 2014. It's 3.1 today. It's not a bad company, but like Brennan said, like if you're going to buy this business, it trades by appointment. So, if somebody who owns a relatively significant for this business amount of shares wanted to sell, I would buy after that when you have an opportune entry point and buy for the dividend. But now, does it deserve a premium multiple? It's not premium to the market, but premium historically for this company. Probably not, unless you see some expansion plans. So if you really wanted and love this name, I would look for it on a more significant dip, and you could see it in an illiquid name like this at some point.
Yeah, just to give an idea about how illiquid it is, it traded a whole 402 shares today. That's not 1,000, that is 402 shares.
Yes,
so about $2,000. The bid-ask spread was $5.05 to $5.30, which is just massive. That's huge spread. It normally would be about 5%, and that's what you'll see with these super liquid stocks. Is market makers will do a 5% spread or even a 10%. As well on the dividend, it is variable. So I'm guessing if they did see a downturn, they would just cut it
100%.
So like at the start of 2023, you saw 19-cent dividend for the quarter, then 11, then 6 cents. Then the last 3 quarters have been 10 cents each. So even if you are an income investor, you're not going to get consistent income in a company like this. And I think if they were ever to find some expansion opportunity, you would probably see the dividend cut or even removed for a time being. That wouldn't surprise me either.
Yeah, agree.
Yeah. And it is really still small. What is the market
It's like
cap?
32 million, I think.
Yeah, it's only 9.6 million in trailing sales in that range, right?
Yeah.
So, it's not like it's trading at, like, sometimes these illiquid situations, we see a company trading at like 0.3 times sales or something. This is trading at a multiple off of sales, right?
Yeah.
So, not a bad business. It's done well over the long term, but you're really in there for that dividend. And I think the CEO himself likes the dividend. He's a significant shareholder, and he's, taking cash out of the company through that dividend, which is his right. But, there's not enough growth here really for us to be interested at these prices.
Yeah, it's interesting just with like the home builders. Like I know that there's another company in Canada which we've been talking about, Ryan and I, where it's just they've been reporting bad numbers, but yet the stock has continued to kind of go up. I
Some of
wonder.
them, yeah.
Well, some of them, yes, exactly,
Yeah.
some of them. There's a few names, and like even just looking at like the premium that we're looking over the historical multiple, like Colin said, I wonder if maybe that's taking place here a little bit. Again, I don't know. I'm speculating.
It could be,
But it
yeah.
could be. There might be
Yeah.
some increased sentiment towards these home builders or
I
whatnot.
think Vitreous, I know this, we've talked to them years ago, but I think they're selling down to US customers, are they not?
And yeah, both.
Yeah,
both,
the end
and
customers, like
Yeah.
in the, yeah, so it's down to US. And I think some of the companies that we looked at that have had higher valuations than historical were servicing the Canadian market. Because like Aaron was talking about, the demand here would be, the need for more homes where we are right now, right? Particularly our affordable housing is great. This is a long-term trend, but at present, you've seen a pullback in spending because of the higher interest rate environment generally in the construction sector. And so you're not seeing those get built right at the moment. So there is, you see some of these companies that are anticipating a longer term, by the end of this decade, more housing needs to get built. But their financials don't show it right now because higher interest rates affect the ability to raise capital to go out and build these projects. So it's a bit of a strange situation where you see lower numbers, and some couple companies that we looked at that, there's parts of the businesses that look good, but you're significant decline in revenues and profitability, and your share price went up in a volatile end market. That is risky. Maybe we'll touch on that in a future podcast. Those companies specifically.